Hello, everyone, and welcome back to Synaptic Investing. I hope you're having a fantastic week and are ready for another deep dive. Today, we're breaking down one of the most interesting and, frankly, one of the most important companies on the market. The colossal backbone of the American healthcare system, UnitedHealth Group. On the surface, it's a fantastic business with a powerful brand. You could almost call it a dominant monopoly. But the real question for us as long-term investors is this. Are the recent margin compressions and regulatory headwinds just a stumble, or do they reveal hidden, structural cracks in the fortress? Is the market right to punish them, or is this the buying opportunity of the decade? That's what we're here to find out.
That's a huge topic. And before we dive deep, a quick heads up for the audience.
Right. If you're looking to invest, we use Interactive Brokers. Use the link in the description for a stock bonus when you sign up.
It's the best way to get a bonus and support the channel at the same time.
And while you're there, please like, subscribe, and let us know your questions in the comments.
Now, let's get into it. Pillar number 1, the business model. Well, actually, before we get to the model, we have to address the elephant in the room. We have to talk about the drop.
Absolutely. We have to set the scene because it is January 29th, 2026. And if you are holding shares of UnitedHealth Group, ticker UNH, you are probably not having a very fun week.
Not at all.
You might be staring at your portfolio and seeing a sea of red.
It is ugly out there.
We are looking at a stock price hovering around, $294 a share? That represents a significant drawdown.
A really significant one.
We are talking about an 11% drop specifically following their 2026 guidance. And I want to pause on the magnitude of that for a second. I mean, for a small cap tech stock, 11% is a Tuesday.
Right. It's nothing.
But for a company with a market cap of $272 billion?
It's seismic. An 11% move on a company of this size is tens of billions of dollars of shareholder value just evaporating very quickly. It's the kind of move that shakes the foundation of the market. It signals that institutional investors, the big money, the pension funds, the people who are supposed to know better, are genuinely spooked.
Exactly. And I think for a lot of people, UNH has always been that sleep well at night stock. It's a stock you buy for your grandmother. It just goes up, right? It compounds at 15% a year, pays a dividend, and you never, ever worry about it.
That's been a machine.
But now we are seeing this valuation compression. I was looking at the numbers, and it's trading at about 16.6 times forward earnings based on their 2026 guidance.
Which is the key context here. We have to talk about relative valuation. Historically, if you look back over the last decade, UnitedHealth Group usually commands a premium.
Always.
It is the best-in-breed insurer. It typically trades in that 18 to 22 times earnings range.
Right.
So seeing it down at 16.6 times implies that the market is suddenly very, very skeptical about its future growth.
The market is essentially saying, we don't believe you can grow anymore, or at least not at the rate we're used to.
Correct. The story has changed, at least in the market's mind.
It feels like the market has put them in the penalty box. And this brings us to that concept we love to talk about from Charlie Munger, the Lollapalooza effect.
The perfect storm.
It's rarely just one thing that knocks a giant down. It's usually a convergence of factors. So let's unpack this Lollapalooza. What exactly hit them in 2025 to cause all this pessimism?
It really was a convergence of 3 distinct, powerful forces, all colliding at once. If it had just been one of these, they probably would have shrugged it off. But all 3 together created this pressure cooker.
Okay, so what was number 1?
First, you had the regulatory environment shifting. We saw significant rate cuts in Medicare funding.
Let's drill down on that. When you say rate cuts, what does that actually mean for the business? How does that hit the bottom line?
So for years, the government has been effectively subsidizing the growth of Medicare Advantage. It's been a fantastic business. They paid insurers very well to take these patients off the government's hands.
Right. It was a win-win politically.
It was. But with the recent regulatory changes, the government effectively tightened the purse strings. They reduced the base rates, and they changed how they calculate risk adjustments.
Which is how they determine how much to pay for sicker patients.
Precisely. So it directly impacts the top-line revenue. The government, their single biggest customer, just flat out said, the party is over, we are paying you less.
That's factor 1. The customer, the biggest customer, Uncle Sam, is paying less. That's never good.
Correct. Then you have factor 2, which was behavioral. And this one really caught the actuaries off guard. We saw a massive spike in post-COVID utilization.
Define utilization in this context for us.
Sure. Think about human behavior over the last 3 or 4 years. During the height of the pandemic and even the years immediately following, people actively avoided the doctor.
Oh, yeah.
They put off that knee replacement. They delayed that elective hip surgery. They skipped routine cancer screenings.
Right. Nobody wanted to go to a hospital if they didn't absolutely have to.
Yeah. Exactly. But in 2025, the dam broke. All of that deferred care came back online at once.
All at the same time.
People finally felt comfortable, or perhaps their conditions worsened to the point that they just couldn't wait any longer. So certainly, surgeries, checkups, delayed procedures, everyone was using their insurance at the same time.
Which sounds good for a hospital. They are busy. But for an insurer?
It is a disaster. Remember, an insurer's business model is collecting premiums and hoping you don't use the service. When utilization spikes, their costs just explode.
So revenue is down because of the government, and costs are up because patients are suddenly seeing doctors more. That is a bad squeeze.
A very bad squeeze.
But there was a third factor, right? The wild card.
The wild card.
Yeah.
Factor 3 was the Change Healthcare cyber attack.
Yeah.
And I don't think we can overstate how significant this was. This wasn't just a small data breach where some emails got out. This was a crippling attack on the core infrastructure that processes payments for the entire U.S. healthcare system.
I remember reading about that. It paralyzed pharmacies and hospitals for weeks. I had a friend who was a pharmacist, and she said they were literally writing things down on paper because the system couldn't verify insurance coverage. It was chaos.
It was a liquidity crisis for the entire medical sector. Change Healthcare is the plumbing. It's the pipes that connect everyone. When the plumbing got blocked by this ransomware attack, money stopped moving.
So what happened?
UnitedHealth had to step in and front billions of dollars to providers just to keep them solvent. It cost them billions in direct costs, fines, and remediation. Not to mention the reputational damage.
So you have revenue being cut, costs going up, and then you have this massive operational crisis that distracts management and just burns cash. It really is a Lollapalooza.
It is, and we can see the damage in the margins. This is where the numbers get a little scary for investors. We're used to UNH being this finely tuned machine. Their operating margins dropped from 8.1% in 2024 down to 4.2% in 2025.
Wow, that is essentially chopped in half.
It is. Even if you adjust for one-time costs, trying to be generous and strip out the cyber attack costs, it still fell to 2.7% on an adjusted basis compared to the prior year.
That is a significant deterioration in unit economics.
It is. It means for every dollar of revenue, they are keeping significantly less profit.
And I want to zoom in on one metric specifically because I think it's the heartbeat of any insurance company and we often gloss over it. The medical care ratio, or MCR. Can you break that down for the audience? Why does this number matter so much?
Sure. The MCR is basically the percentage of every premium dollar that gets spent on actual medical claims. It is the raw cost of goods sold for an insurer.
Okay.
If you collect $1 in premium and you have to pay out 80 cents to doctors and hospitals for medical care, your MCR is 80%. That leaves you 20 cents to pay for your staff, your technology, your buildings, and hopefully generate a profit.
Right. So low-M is usually better for the insurer. You want to keep more of that dollar.
Generally, yes. Or at the very least, you want it stable and predictable. In 2025, UNH's MCR deteriorated to 89.1%.
89.1%. So almost 90 cents on every single dollar is walking out the door immediately.
Exactly. Compare that to 85.5% in 2024. That shift might sound small to a layperson as just under 4 percentage points. But when you are dealing with nearly $450 billion in revenue, that shift wipes out billions in profit.
Billions.
It tells us that medical costs rose much, much faster than UNH could raise their premiums.
And that challenges the whole investment thesis, doesn't it? The assumption has always been that UNH has immediate pricing power. If costs go up, they just charge more next year.
Right.
But this 89.1% number says, wait a minute, maybe they can't just snap their fingers and pass on the costs.
Precisely. It exposes a lag in their model. It exposes a vulnerability. And that is what the market is reacting to. The market hates uncertainty. And right now, UNH's pricing power is uncertain.
Okay.
But, and this is a big but, before we write them off as a broken company, we have to understand the machine itself. Because this isn't just a standard insurance company.
That leads us perfectly into pillar 2, the machine. How does UnitedHealth actually make money? Because I think most people just see the insurance card in their wallet, look at the logo, and stop there. But it's really a dual-engine model, isn't it?
It is. It's a bit of a black box for the average person. But for an investor, you have to separate the two arms. If you don't understand the difference between the two engines, you can't understand the stock.
So what are they?
Engine 1 is UnitedHealthcare, or UHC. That's the insurance arm.
Okay, that's the traditional business, the one we all know.
Right. They collect premiums from employers, the government via Medicare and Medicaid and individuals, their job is to manage risk for nearly 50 million members. If you get sick, they pay the bill. If you stay healthy, they keep the premium. It's the classic betting against you getting sick business.
Okay, simple enough. What's engine 2?
Engine 2 is Optum. And this is where it gets fascinating. Optum is the services arm. This isn't insurance at all. Optum is a massive conglomerate of healthcare services. They provide care delivery, actually owning the doctor's offices, the urgent care clinics, the surgery centers. They manage pharmacy benefits via Optum Rx, the PBM. And they provide technology and data analytics via Optum Insight to the broader health system.
So Optum is making money on fees and services regardless of who pays the bill.
Exactly. Optum is a fee-for-service and capitated revenue engine. If a patient walks into an Optum clinic, Optum gets paid. It doesn't matter if that patient is insured by UnitedHealth Group or Aetna or Cigna, Optum gets paid for the work.
So they're playing both sides of the field. And the magic happens when you connect these two engines. This is what we call the flywheel thesis, or vertical integration.
Yes, this is the holy grail of their strategy. It's what makes them different. Think of it as a funnel. UnitedHealthcare uses its massive membership base, those 50 million people, to funnel patients into Optum doctors and Optum pharmacies.
Let's play that out. I have UnitedHealthcare insurance. I get sick. I go to a doctor.
UnitedHealthcare says, hey, if you go to this Optum doctor in our network, your copay is lower. So naturally, you go to the Optum doctor.
Okay. So I pay the doctor. Or rather, my insurance pays the doctor.
Right. UnitedHealthcare writes a check to pay for your visit. But who do they write the check to? They write it to Optum.
Which is owned by the same parent company.
Exactly. It's the left pocket paying the right pocket. The money stays in the house.
I see.
And because they own the providers, Optum can, in theory, provide care at a lower cost structure for UHC because they eliminate the friction and the negotiation and the administrative waste.
Right. So UHC saves money on claims because they are paying their own sister company. And because Optum lowers costs for UHC.
UHC can turn around and offer lower premiums to employers compared to competitors who don't own their own doctors.
And lower premiums win them more members.
More members means more patients to funnel into Optum, and the wheel just spins faster and faster.
It's a self-reinforcing loop. It's brilliant, really. And we actually saw evidence of this in 2025, didn't we? Even with the bad margins we talked about earlier, the growth story was still intact on the top line.
We did. In 2025, despite all the chaos, UHC grew to nearly 50 million members. That's a huge number, and that member growth directly fed Optum, which saw 7% revenue growth. So the machine is still capturing people. The funnel works.
The problem is just that the cost of treating those people went up faster than expected.
Precisely. The model works, but it's not immune to inflation.
We also need to talk about the sheer scale here. I mentioned earlier that they are the backbone of the system. We're talking about a revenue base of $447 billion.
It's a staggering number.
It's larger than the GDP of many mid-sized countries. It's bigger than Austria's GDP. I mean, it's just hard to get your head around.
It is massive. And that scale is their primary economic moat. We call it scale economy shared. It allows them to spread their fixed costs, all that technology, the compliance teams, the infrastructure for Optum over a wider base than anyone else.
It's like Amazon.
It's the Amazon effect applied to healthcare. A smaller insurer, say a regional player, simply cannot match their unit costs because they don't have $447 billion of flow to amortize expenses against.
It's a low-cost advantage that gets stronger as they get bigger. And then you have the network effects, right, specifically with data.
That's the second part of the moat. We call it data gravity.
Yeah.
Optum Insight and Optum Rx process so many claims, we're talking billions of transactions, that they have better data on health trends than the CDC, arguably. They know exactly what treatments cost in every zip code in America.
Which is an incredible advantage for pricing and underwriting.
It is. More claims data leads to better risk scoring. Better risk scoring allows for sharper pricing. That attracts more payers and providers who want access to that insight, which in turn generates even more data. It becomes this black hole of information that just sucks everyone else in.
So, on paper, this looks like an unassailable fortress. You have scale, you have vertical integration, you have data gravity. But, and here's the big but that we started with, the stock is down. The margins are crushed.
Right. The theory is great, but the reality has been painful.
So we have to ask, is the moat drying up?
That is the pivotal question for Pillar 3, the threat assessment. We have to run an anti-moat check.
Yeah.
We have to be critical here and really challenge the thesis.
Let's play devil's advocate. What is threatening this fortress? It feels like the government is playing a huge role here. The government gives, and the government takes away.
It is. We have to talk about regulatory capture risks.
Yeah.
For a long time, UNH benefited from the government effectively outsourcing Medicare to private companies like them, who we call Medicare Advantage. It was a gold mine.
An absolute gold mine.
The government overpaid, and insurers kept the difference. It was a fantastic subsidy. But the political winds have shifted.
We're seeing the impact of the Inflation Reduction Act and those Biden-era changes to Medicare. It seems like there is bipartisan agreement that insurers are making too much money off the taxpayer.
Exactly. The government looked at the profits these insurers were making and said, wait a minute, we are overpaying. The changes effectively cap the excess rent that UNH can extract from the government.
So the business of government-sponsored plans is becoming commoditized.
That is a scary word for an investor. Commoditized. It implies you have no pricing power. It implies you are selling a generic product.
Like corn or oil.
Right. Commoditized means you are just competing on price, and margins get grinded down to zero. If Medicare Advantage becomes a commodity where the government sets a strict cap on margins, say you can only make 3%, then UNH stops being a growth stock and starts looking like a regulated utility.
A utility, like a power company. Reliable, boring, but not something that compounds at 20% a year.
Precisely. And that is the fear. If the government legislates that you can only make a sliver of profit, the multiple on the stock has to come down permanently.
But wait, UNH isn't just taking this lying down. They are trying to reprice, right? We talked about that lag earlier. They're going back to employers and saying, hey, we need more money.
Yes, absolutely. The 2026 outlook implies a massive repricing effort. They are aiming to get that medical care ratio back down to 88.8%.
How do they do that?
Basically, they are going to their customers, employers, and the government and saying, hey, medical inflation is 10%, we need to raise premiums by 12%. They're trying to get ahead of the cost curve.
But there is a timing mismatch there that makes this painful.
A huge mismatch. Inflation happens in real time. Every day a patient goes to the hospital, the cost is higher. But insurance contracts are usually signed once a year.
Right, during open enrollment.
You sign up for your plan in November, and the price is locked for 12 months. So UNH is stuck paying 2025 prices with premiums that were set based on 2024 data.
So they are chasing the train. The question is this just a temporary lag? Will they catch up in 2026? Or is there a structural flaw here?
That's the debate. That's the whole ballgame. If medical inflation remains sticky, let's say it stays at a 10% trend because of new expensive drugs or labor shortages, but UNH only has enough pricing power to raise rates by 5% to 7% because customers simply can't afford more.
Then the spread inverts permanently.
Exactly. If costs go up 10% and you can only raise prices 7%, your margin shrinks every single year until it vanishes. You lose money on every member.
That's the bear case, that the cost of care has permanently outpaced the ability of society to pay for it, and UNH is left holding the bag.
It's a very real risk. We can't ignore it. But we also have to look at how the company is navigating this storm. Which brings us to Pillar 4, financial resilience and management integrity. Because how management handles a crisis tells you more than how they handle a boom.
I think this is where we separate the signal from the noise. It's easy to panic when you see margins drop. But let's look at the checkbook. Cash doesn't lie.
It doesn't.
Earnings can be manipulated, adjusted, smoothed. But cash is cash. How is the CEO managing the cash?
This is where UNH really shines, in my opinion. This is the fortress part of the argument. Despite the crisis, despite the cyber attack costing billions, despite the margin compression, they generated $19.7 billion in operating cash flow in 2025.
That is a cash machine. Nearly $20 billion in cash, even in a bad year. That is almost hard to comprehend.
It is. The engine is still printing money. The business isn't broken. It's just less profitable than perfection. And I want to highlight something that often gets overlooked in these deep dives: stock-based compensation, or SBC.
Oh, I love this metric because in the tech world, we talk about tech stocks a lot on this channel. We see companies claiming they are profitable, but then you look at SDC and they are printing millions of shares to pay their employees, diluting the shareholders.
It's a huge problem in tech. It's a hidden inflation for shareholders. It's a non-cash expense that is very, very real. But look at UNH. Their stock-based compensation was only $971 million.
Less than $1 billion.
Now, that sounds like a lot of money to us, but it is only 4.9% of their operating cash flow. Compare that to a company like Palantir or ServiceNow, where SBC might be 20% or 30% of revenue, sometimes more.
That is incredibly low compared to modern large caps. It's a sign of a very mature, disciplined culture.
It is. It signals high earnings integrity. Management isn't enriching themselves at the expense of shareholders via massive dilution. They're paying themselves out of real cash flow, and there's plenty left over.
And let's talk about ROIC, return on invested capital, because if I give the CEO $1 of my money, I want to know how much he's making for me.
Right. Even with the compression, their ROIC is hovering around 12% to 13%. Now you should compare that to their cost of capital, their WACC, which is probably around 6% or 7% given their credit rating.
So the spread is positive,
Yeah.
very positive.
Yes. They are still generating returns double their cost of capital. They are creating value, pure and simple. They aren't burning furniture to stay warm. The machine is still efficient.
So the engine is efficient. Now, what did they do with that $19.7 billion? Did they light it on fire? Did they make a stupid acquisition?
No, they followed a very rational, very boring playbook. First, dividends. They paid out $7.9 billion to shareholders. That is reliable. It's a check in the mail. If you own the stock, you got paid.
Okay.
But look at the buybacks. This is interesting.
I noticed they slowed down. In 2024, they bought back $9 billion of stock. In 2025, only $5.5 billion. Some investors might see that as a bad sign, like, why aren't you buying the dip? If the stock is cheap, buy it.
And I see it as prudence. I see it as good management. We have to remember the context. They had a cyber attack that paralyzed their liquidity.
Right.
It cost them nearly $3 billion in cash and fines and fixes. Management prioritized liquidity. They kept cash on the balance sheet to weather the storm rather than blindly buying back stock just to prop up the share price.
That is adult behavior.
That's very rational behavior.
I agree. It shows they aren't panicking. They are keeping the ship steady. They wanted to make sure they could pay the bills and help the providers before they rewarded themselves with buybacks.
Exactly.
So we have a company that is printing cash, has honest accounting, and prudent management. But the stock is down. So let's get to the part everyone is waiting for. Pillar 5. Valuation. Is it cheap?
This is where we get to put on our mathematician hats. Let's do a reverse DCF, a discounted cash flow analysis working backwards. This is my favorite way to look at a distressed stock.
Walk us through that logic. At $294 a share, what is the market pricing in? What does the market believe?
At this price, the market is effectively saying that UnitedHealth Group will have 0 to low single-digit growth in perpetuity.
Zero growth. For a company that owns the healthcare system, that seems pessimistic.
Essentially, yes. The market is betting that the 2025 margin compression is permanent. They are betting that the margins never recover, that the government keeps cutting rates, and that UNH just treads water forever.
Okay, so that's the wager. If you buy the stock today at $294, you are betting that the market is wrong and that they will return to some level of growth.
Correct. You don't even need them to return to heroic growth. If UNH just recovers to its historical target of 13% to 16% earnings growth, which they have done consistently for decades, the stock is wildly mispriced.
You are buying a Ferrari for the price of a Honda Civic because the Ferrari has a flat tire.
That's a great way to put it. You're betting they can fix the tire.
So let's triangulate the value. If we assume they fix the tire, what are the numbers telling us it should be worth?
Let's use two methods to be safe. Method 1, mean reversion. This is the simplest. If we assume they get back to their historical valuation of roughly 18 times earnings, which is where they usually live, and we apply that to their 2026 earnings guidance of $17.75.
Which gives us?
That gives us a price of roughly $319.50. That's a decent upside from here. About an 8 or 9% jump just on valuation normalization.
Okay. And method 2, summing based on cash.
Method 2 is what I call owner earnings. Let's ignore the PE ratio and just look at the cash. They generated about $21.62 per share in free cash flow. That is cash that belongs to you, the owner.
Yeah.
If we apply a very boring, no-growth multiple of 15x to that cash.
Just treating it like a bond, assuming it never grows again.
Exactly. A very conservative multiple. 15 times $21.62 gives you roughly $324.
So both methods, mean reversion and owner earnings, point to a fair value well above $300.
Correct. They both suggest the stock is undervalued right now.
And we are sitting at $294.
Which puts us in the buy zone. I'd argue anything between 285 and $310 is a compelling entry point. The pessimism regarding Medicare rates and the cyber attack has created a margin of safety.
You're basically getting the growth option for free. If they figure it out, you win big. If they just trudge along, you're still buying cash flow at a discount.
Precisely. It's an asymmetric bet.
Mm-hmm.
The downside seems limited by the massive cash flow, but the upside is significant if sentiment shifts. But as long-term investors, we aren't just looking at next year. We need to look at the next decade.
Yes.
Which brings us to Pillar 6, the long horizon view.
This is the strategic pivot that I think is the most exciting part of the story. Because if you think UNH is just an insurance company in 2035, you're missing the point. You're looking at the past, not the future.
You really are. They are undergoing a metamorphosis. They are moving from being a managed care insurer towards a health operating system.
Explain that distinction. What does a health operating system look like compared to an insurer?
Well, as we discussed, managed care insurance is regulated, it's capped, the government tells you how much profit you can make. It's a tough political business.
Right.
But health services Optum is largely unregulated. There is no cap on how much money a doctor or surgery center or a software platform can make.
So the goal is to shift the center of gravity from UHC to Optum.
Exactly. Right now, it's roughly a 50-50 split on earnings between the two engines. But the prediction and the stated goal of management is that in 10 years, Optum should contribute 60% to 70% of the total enterprise value.
That's a huge shift.
They want to commoditize the insurance layer, make it boring, make it low margin, just to feed the high margin Optum engine.
It's like Apple. The hardware, the iPhone is great, but the services, the App Store, iCloud, is where the insane margins are.
Perfect analogy.
UNH wants insurance to be the iPhone. Everyone has it, so they can sell you the high-margin services.
That's a great analogy. And a big part of that is the physician-led strategy. We hear about them buying doctor groups all the time. Why does that matter so much?
It seems to be their #1 priority for acquisitions.
It's the cornered resource strategy. By 2035, UNH aims to be the largest employer of physicians in the U.S. Think about that for a second. The insurance company becomes the doctor.
That is wild, and arguably a little dystopian for some people.
It creates some ethical questions, sure, we can't ignore that.
Right.
But financially, it's genius, because the profit in healthcare typically leaks out to hospitals and independent providers.
Right.
If you own the doctor, you internalize that profit pool. You keep the money in the house. You pay yourself to treat the patient.
It effectively eliminates the conflict of interest between payer and provider because they are the same person.
Or at least it aligns the financial interest. If I am the insurer and the doctor, I have every incentive to keep you healthy and treat you efficiently. I don't want to overtreat you because I pay the bill, and I don't want to undertreat you because I own the brand and you might sue me.
And then you layer on the tech angle. We have to talk about AI and process power. We mentioned they have more data than anyone. How do they use that?
This is where the scale becomes a weapon. We said they process more claims than anyone in the Western world. That is a lot of data. It is the ultimate training set for AI.
Right. You can't train a model without data. More data equals a better model.
Exactly. With AI, the marginal cost of processing a claim, checking the codes, approving the payment, flagging fraud moves towards zero.
So the administrative burden, the army of people stamping forms goes away.
It gets automated.
Yeah.
And because they have more data, their AI models will be better than anyone else's. This creates an efficiency frontier that smaller players cannot touch. We call this Power 7, process power.
Explain that.
If UNH can process a claim for 1 cent and it costs a competitor $1, the game is over. The competitor bleeds to death. They can't compete on price or efficiency.
That's the bull case for the next decade. The health OS powered by AI and owning the doctors. But we have to be realistic. There is a gravity problem here. We call it the S-curve reality check.
We do, and this is the sober warning. The law of large numbers is undefeated.
Always.
To grow their revenue at 13%, which is their target, on a base of $450 billion, they need to create roughly $60 to $70 billion in new W revenue every single year.
That is insane. That is like creating a Fortune 100 company from scratch every single year just to hit their targets.
It's incredibly difficult,
Right.
just mathematically. There aren't enough doctors to buy. There aren't enough patients to sign up. So the reality is that future EPS growth earnings per share will likely come heavily from share buybacks rather than pure top-line revenue growth.
We call that the cannibal effect. The company eating itself to keep the share price moving.
It works, and it can work for a long time, Look at Apple or McDonald's. But it's a different kind of growth than the hyper-growth of the past. It's financial engineering growth, not organic explosion. You have to be aware of that.
Okay, we've been pretty positive so far, mostly. But we are synaptic investing, and we have to do a proper red team challenge. We have to try to kill the thesis. If we are wrong, why are we wrong? Pillar 7, risks.
Let's look at the Intel argument.
Ooh, that stings. Intel in 2012, dominant monopoly, printing cash, cheap stock, and then a decade of pain.
It's a valid comparison. The thesis for Intel was they have a monopoly on PC chips. They're invincible.
Oh.
But the world shifted to mobile, and they missed it. The thesis for UNH is they have a monopoly on managed care. But what if the world shifts?
And the shift here isn't technology, it's policy.
Exactly. The thesis is you are buying a monopoly just as its core subsidy, that Medicare Advantage arbitrage, is being removed. If the government decides to stop overpaying, the model breaks.
And if seniors start churning out of plans because the benefits get cut, I mean, that's the whole reason they sign up.
Then UNH gets left with what we call adverse selection. The healthy people leave because the plan isn't rich anymore, but the sick people stay because they need the coverage.
And that destroys the risk pool.
Completely. In that scenario, UNH isn't a compounder on sale. It is a utility entering secular decline. You end up with a portfolio of sick people and no government subsidy to pay for them.
That is the terrifying bear case. And then there's the too big to secure risk. We have to circle back to the cyber attack one last time.
We do. That attack cost them $2.8 billion financially, but the operational failure was worse. It proved that their systems are so sprawling, so complex, stitched together from hundreds of acquisitions.
It's a Frankenstein monster of IT systems.
It is. And that might be impossible to fully secure. If you have thousands of entry points, you can't lock every door. It's a massive surface area for attack.
And if you can't secure the medical data of 50 million people?
You lose the trust moat. And if the trust goes, the regulators step in. The ultimate terminal risk here is an antitrust breakup.
Wow.
The government decides they are simply too big and too dangerous to exist as one entity. You are a systemic risk. We are breaking you up into 5 baby UNHs.
That is a sobering thought. So we have the bull case, AI-driven health OS, undervalued cash machine, pivot to services. And the bear case, declining utility, security risk, government target.
It really is the $272 billion question.
So let's wrap this up. What is the final synthesis? How should our listeners think about this stock right now?
For me, when I weigh it all up, I see a high-quality compounder that is temporarily stumbling. The vertical integration, the UHC plus Optum engine, is still the strongest economic engine in healthcare. No one else has it. The cash flow is undeniable.
I tend to agree. I acknowledge the utility risk. The government's a tough customer. But the price right now at 16 times earnings implies too much pessimism. It's pricing in failure, and I don't think this management team is going to fail. They have too many levers to pull.
The margin of safety is there. It's a rare chance to buy a blue chip at a discount. It doesn't happen often.
Here is my final thought for you to chew on, and it's a bit provocative. If UnitedHealth Group successfully uses AI to automate the administrative burden of healthcare, they don't just improve margins. They effectively become the central nervous system of American medicine. They become the OS. But if they fail to secure that nervous system, they become the biggest systemic risk in the economy. The bet you're making today is on which version of big they become.
That is a fascinating way to frame it. The stakes couldn't be higher.
Thanks for listening to Synaptic Investing. We'll see you in the next deep dive.